Hi guys, it's Stock Curry, and wow, what a crazy day in the markets. The market started out up 2% and then finished the day down 1%. But don't worry, in today's video we're going to talk about 12 stocks that might rise as the market continues to fall. So let's get into it! Alright, before I get into these 12 stocks, I wanted to give you my market prediction and where I see the market going for the rest of this week and next month. Right now, we have seen a major drop in the markets. We are in correction territory, and it has just been nothing but red for the past 3 weeks. Now, the problem is the market just can't keep going down like this forever for, say, the entire rest of the year, because what would happen is by the end of the year, the market would literally be at zero. It would have a 100% loss. Obviously, that can't happen. So what generally happens in these bear markets is we'll get this where we get like 3 weeks down, and then we'll get a week where it goes up, or 2 weeks where it goes up, and then another 2 or 3 weeks down, and it's this stair step down. It's not a straight line down. It tends to zigzag on its way down. So that's what we're kind of looking for in the markets right now. So where I see the markets going is, first of all, Friday I think is going to be a green day. I think we're going to get a little bit of a reprise on Friday, either be green or flat, and then Monday, Tuesday, Wednesday, I can see those days trading down to flat. Now, on Wednesday, Tuesday and Wednesday, the Fed is speaking, and then Jerome Powell is actually going to speak on Wednesday. And I think that once Jerome Powell speaks, he's going to announce that the Fed has decided to basically do nothing for January. They're not going to raise interest rates, the tapering is just going to end, and they're also not going to sell any of their bond assets. I think they're just going to stay pat and do nothing. And I think the market is going to respond very favorably to that, and that is going to kick off a rebound in the market. So I think starting Wednesday, we're going to see green days. I think the market's going to be up massively on Wednesday and Thursday, and just go up from there. And then what I think is going to happen is we're going to go green for a couple of weeks, and then about 3 weeks from Wednesday, the Fed is going to release their meeting minutes from January. And I think the market is going to read those meeting minutes, the market is going to freak out, and the market is going to tank again. And then I think it's just going to go down for a while before we really see the drop in March once the Fed actually starts raising interest rates. So that's my market prediction. We'll see what happens. Let's go ahead and get into these 12 stock picks. All right, before we get into today's stock picks, I do want to remind you that I am not a financial advisor. Nothing I talk about today is a recommendation to buy, sell, or hold. These are just my opinions, which may or may not be accurate. Please do your own research before investing in any asset. Okay, the first stock we're going to talk about today is BKE. This is Buckle, and they're a casual apparel retailer. Joseph Hogue listed BKE as one of the 7 stocks to buy that will hold their value during rising inflation. Now, I get that thought that as inflation rises and prices get more expensive, that people will start shopping at more discount retailers, but BKE's revenues aren't really growing. In fact, BKE is averaging a 1.9% revenue loss per year. So I disagree with Joseph Hogue that BKE would be a good investment. BKE already ran up during the rising inflationary period last year, and the stock has been falling for the past 2 months. While it might be a little undervalued in the short term, in the long term, I think BKE will continue to drop in price. Next up is LITE. This is Lumentum Holdings. They're an optical components manufacturer for the telecom industry. Joseph Hogue listed LITE as one of 7 stocks to buy to beat inflation. LITE has seen a 15% annual revenue growth rate over the past 4 years, but the revenue growth has slowed to only 3.82% last year, and last quarter, LITE actually saw a decline in year-over-year revenues. So my concern with LITE is that it might be dying, and that's not the kind of company that you want to invest in when interest rates are rising and it's getting more expensive to do business. So LITE is actually one that I would stay away from. All right, these are going to get better, I promise. I've got some real gems in here. Now next up is LPL. This is LG Display. LG is one of the world's leading electronics manufacturers. Joseph Hogue listed LPL as one of 7 stocks to buy to beat rising inflation and rising interest rates. Now, my concern with LPL is that they don't have consistent revenue growth, and they haven't been profitable since 2017, although it does look like they will turn a profit in 2021. Now, if you look at the monthly chart in LPL, you can see how it has pretty much been a falling knife for the past 10 years. Over the past few months, however, LPL has been rising, and a lot of that has to do with the fact that they are finally turning profitable. Fundamentally, the price is cheap with a price to sales ratio of 0.3. Now, if you do think LPL will continue to show profits, then now would be a great time to buy in. But if you think that the profits are just temporary and that they're going to go away, then I would just stay away from this one. Next up is NFLX. This is Netflix. Larry Jones let us know that NFLX dropped over 20% after hours after they reported earnings and subscriber growth slowed. Now, I'm not going to go into details on the earnings. I just want to point out that NFLX was already trading well below the 300-day EMA. A lot of people were buying the dip on NFLX. And what happened? Did it rebound? No. It fell another 20%. And to show you just how bad of a fall this was, I've got my cursor on the screen of where the price ended up at after hours. This was a major dip, bringing NFLX all the way back to a price level it has not been at since May of 2020. This is a great example of how during a bear market, just when you think a stock can't drop any lower, it does. So be careful out there and don't just go around buying dips. Make sure the companies you are buying are value stocks with low PE ratios. That will give you a better chance of making money long term. Next up is NTR. This is Nutrien, and they are the world's largest fertilizer producer. Joseph Hogue listed NTR as one of 7 stocks to buy now to beat inflation. I really like NTR as both an inflationary and interest rate hedge. Large companies will continue to buy fertilizer no matter how expensive it gets. NTR is seeing an average annual revenue growth of 4.8% per year. The stock is fairly priced and has great momentum on the technicals. NTR should continue to rise in price as the market overall drops. I would wait for a pullback to the 100-day EMA at around $69 before buying in. NTR is not 100% a value stock though, so watch out for a possible drop below the 100-day EMA. Next up is PLTR. This is Palantir, and they're a data analytics company. Tom Nash put a bunch of bearish numbers into his DCF to try to determine in his mind what PLTR should be worth in a bear case scenario. And the number Tom Nash came up with was $25, which is 70% higher than where it closed at on Thursday. Now, the thing you need to understand is during a bear market, stocks will often fall far below their fundamental values. So if you're a long-term investor, a bear market is an opportunity to make millions of dollars by buying stocks at ridiculously low valuations. If you're a short-term trader, you need to be careful because no matter how cheap a stock is, it can always fall further. Next up is PTON. This is Peloton, and Stock Mode discussed PTON after it dropped over 20% on Thursday. PTON reported that they were halting production of their bikes and treadmills due to soft demand. Up until last quarter, PTON had seen a consistent revenue growth of over 100% per year. But last quarter, that revenue growth dropped to only 6%. PTON is now trading at a level that it has not seen since March of 2020. PTON appears to be a victim of inflation. The company has not yet had a profitable year, and rising interest rates are going to hurt PTON further. So the drop in price is justified. This is not a stock to buy the dip on, as it could continue to fall throughout the remainder of this year. I would have to see a rebound in PTON sales before I would be interested in buying this stock. And next up is SAFM. This is Sanderson Farms, and they're a chicken processor in the United States. Joseph Hogue listed SAFM as one of 7 stocks to buy now that will perform well as inflation and interest rates rise. SAFM has seen an average annual revenue growth of just over 10% per year. The revenue growth is flattening out though as the rise in inflation slows down and higher employment costs eat into profits. Despite the recent run-up in the stock price, it is still trading in value territory. SAFM also has a dividend with a 0.94% dividend yield. I agree with Joseph Hogue that this would be a good stock that should hold its value well as the stock market falls during this bear market. And next up is SAIA. This is SAIA, however you pronounce that. They're a transportation logistics company focused on trucking. Joseph Hogue listed SAIA as one of 7 stocks to buy now that will beat inflation. SAIA is growing revenues by over 10% per year on average, and their revenue growth rate has been increasing over the past 2 quarters. No matter how high inflation goes, people will continue to ship their products across the country via truck. So Joseph Hogue is right that SAIA should continue to perform well even as inflation and interest rates rise. My only concern with SAIA is that it's still trading at a premium. SAIA should be trading at around a PE ratio of 20, but their current PE ratio is over 30. The price to sales ratio is also high at 4.2. So despite SAIA being a company that should get through this period of rising interest rates just fine, because the stock is overvalued right now, I do think it will fall along with the overall market during this bear market. So I don't think SAIA would be a good stock to buy right now. It would, however, be a great stock to buy once this bear market is over and the valuation drops considerably. And next up is SOFI. This is SOFI, and they're an online fintech startup. SOFI failed to really take off Wednesday when they got their banking charter, but the stock really woke up on Thursday. Even though SOFI gave back most of its gains during the day, it still finished the day up over 9%. Meet Kevin did a 30-minute deep dive into SOFI and ultimately came up with a price target of $54.27 by 2025. That's a 38% annual rate of return. To extrapolate that, it would be a $20.69 one-year price target. Stockmo was more bullish, and he said he thinks SOFI will finish the year above $30. Because SOFI is a fintech startup though, I think it will struggle this year with rising interest rates and won't really start taking off until next year. But of course, if the stock picks up enough interest from retail investors, then SOFI could take off at any time. And next up is TSLA. This is Tesla, and they're an American EV manufacturer. Invest with Henry thinks TSLA will go up after earnings. Therefore, he opened a bullish call spread. He bought a $1,050 January 2023 LEAP call option, and he sold a $1,150 January 2023 LEAP call option. That spread allows Invest with Henry to be bullish on TSLA while also lowering his overall cost. His net cost was only $36 per contract rather than the $246 if he had purchased the call option by itself. In other words, Invest with Henry only spent $3,600 in each contract rather than $24,600 in each contract. And since the spread is $100, Invest with Henry has the potential to make $10,000 with a $3,600 cost. So Henry has the chance to 3x his money with his option spread. As you can see, opening a call spread rather than just a straight call can significantly lower your overall cost on a contract, possibly lowering the cost by as much as 80 or 90%. The downside is that you are also limiting your max profit. Rather than having an unlimited max profit like you would if you had just bought the call, your max profit is limited to the amount of the spread. But if you are willing to give up some of your profit potentials, you can buy options on expensive stocks using this strategy. And the last stock we're going to talk about today is TSN. This is Tyson Foods. They're a chicken producer in the United States. Joseph Hogue listed TSN as one of 7 stocks that would do well during a time of high inflation. TSN remained profitable throughout 2020 and 2021, which is a good sign for a mature company. Growth is minimal at 5.34% per year, so this is by no means a high growth stock. Instead, this is just a company that will hold up during a period of rising interest rates because people are going to continue to eat chicken no matter how expensive it gets. So don't expect to make a killing with TSN. This is just a pillar stock that should hold up well no matter how far the market drops. Now that said, TSN is about to turn bearish on the technicals, so I would wait for a pullback before buying in. TSN historically bounces off of the 100-day EMA, so I would be looking for a buy-in price at around $84.
Alright, I hope you enjoyed this video and get a lot out of it. Comment down below what your favorite stock pick is. And remember, you don't have to go crazy and trade options in order to make a lot of money in this market. You can actually make money with stocks even while the market goes down. Spartacus said, "Hey Stock Curry, I played out the hand on Vail when it was a falling knife. I'm up 37% on my position at the moment." If you want to know about more stocks that you can be up 37% on, then come join us at the free Discord. You can fill out the application at stockcurry.vip/discord. Every single person who applies gets approved. I just have the application there to help prevent scammers. On that Discord, we're talking about stocks, options, and crypto all day, day and night. So come join us over there and find some more stocks that you could be up 37% on. Now, if you're looking for a broker to trade with, then I do recommend Webull. Webull offers the full pre-market and after hours trading from 4 a.m. until 8 p.m. Eastern Time. They also have multi-leg options trading that makes it very easy. And right now, when you sign up for Webull using my link in the description below and deposit just $1, Webull's going to send you 2 free stocks worth up to $3,300. Now, if you're not a U.S. resident or if you're looking to trade OTC penny stocks, then I recommend Interactive Brokers. Interactive Brokers also offers the full pre-market and after-hours trading. They also have options trading, and they have highly discounted trading for non-U.S. residents. Now, I do want to remind you that I have material connections with both of those, so whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. Now, finally, I want to remind you to hit that like button, subscribe, and click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.